Hello, listeners. I welcome you to yet another informative and interesting episode of our program series, Policy Formulation and Economic Development on Amorgate Radio Communication. I remain your host, Titulola Ogunshono. On today's episode, we'll be considering in details the determinant of economic development. Last episode, we introduced this topic by starting with the economic factors that determines economic development in any nation. I mentioned about three economic factors. The first was overdependence on imports and overdependence on exportation of primary products. I mentioned another determinant of economic development by stating that the level of debt owed by a country will determine the level of development in such a country. And I mentioned the third when I mentioned capital flight as an economic determinant of economic development of a nation. We'll be diving further to consider other economic and non-economic factors that determines economic development of a nation. Today, the first economic factor that I'm going to mention is the level of savings and capital. The level of savings and capital in a nation will determine the level of economic development in that country. We have what we call the Arrow-Doma growth model, and this just looks at the relationship between savings, investment, and economic growth. Savings and investment is speculated to have a positive or what we call direct relationship with economic growth. The more people save, the more they save, they can accumulate capital stock, and that will lead to an increase in economic growth. Recall that I said economic growth is when you talk about the monetary value of final goods and services that a nation produces within a given period of time, usually a year. So it's expected that part of your income as individuals, your citizens in a country, part of that income goes into savings, and that savings will be plowed into investment activities. So when savings increases, it's expected that the level of investment, in a country also increases. And when the level of investment in the country increases, it leads to higher capital stock in that country. And when the capital stock also increases, you expect that definitely it leads to higher output and thus higher economic growth. And when it's sustained over a period of time, you expect it, if properly managed, if the growth is it takes a sectoral balance. That means if growth is taking place almost in every part of the sector, the agricultural sector, petroleum sector, mining sector, transportation sector, communication sector, taking place across all sectors, is expected that will lead to economic development. So what happens in an environment? What happens in a macroeconomic environment in a particular nation when there is a drastic fall in savings? Once there is a drastic fall in savings, a decline in savings, it means that the tendency for your people to want to plow back into productive activities is going to decrease. And when the level of investment decreases, definitely the level of capital stock decreases, and when it decreases, definitely it's going to affect your level of economic growth. It's going to lead to a sharp decline in your gross domestic product as a measure of economic growth. And it's going to have multiplier effect. It means that when you cannot invest more, you can't produce more, it's going to limit business expansion. And when businesses are not expanding, what happens to the rate of employment? Definitely you can't provide enough job opportunities. The unemployment rate will be on the high. And when this is like that, we recall that we talk about economic development, you are speaking to core values, you are speaking to the standard of living of your people, social, institutional factors, changes. So what happens when people are not employed? It means they cannot even afford basic food, shelter, clothing, not talk about self-esteem. That'll be a factor. So it means that if you do not get this right, if there's a huge deficit in your savings investment gap, when there's a big gap between that, it's going to limit, your level of development as a nation. So every government would want to look at macroeconomic factors that would encourage savings. We want to look at those structural factors that would encourage investment in that country, because I've said that You can have economic growth without development, but the basis of development is economic growth. So the level of savings and capital in a country will determine the level of development of that country. So let's consider the second economic determinant affecting economic development of a nation, and that is access to finance. Limited access to finance by firms, especially the ones that we call the MSMEs, that is the micro, small, and medium enterprises, would hinder economic growth and development in a nation, because the number of MSMEs, the micro, small, and medium enterprises, is usually so large in a nation. And these are really crucial to economic development of any nation because they have higher capacity to employ the people. So when they have access to finance, they can expand. And when they do not have, access to finance, access to loans for the expansion processes, access to loans to finance big projects, it means they cannot create job opportunities for citizens. This would affect the level of economic development in any nation. And there are pertinent questions when you are to ask, when you are considering accessibility to finance, because one of the things that will affect it again is how easy is it to access these funds. Are there bottlenecks when organizations and are still growing? Remember, we said they're micro. When they're micro, it means that the annual, income earned is about 5 million. And it means the number of people in that organization will not be more than 10. When we talk about the small, it means that the annual income, the small enterprises, those who fall under this category are those whose annual income are usually less than 50 million. And the amount of people, the number of people they can actually employ is usually between 10 to 49 people. And when we talk about the medium enterprises, we are talking about those with turnover of annual income of over 50 million, but less than 500 million. Okay, so look at the category of these people. How many of these enterprises do you have around you? So one pertinent question is, can they access loans easily? Okay, and because sometimes when you look around, some questions that will just prop up again is sometimes yes, well, they can access these loans, but the question is, are there collateral or documentation issues? Because my banking experience, they would approach us, but sometimes they cannot get this funds because of documentation issues. He wants titles to the landed properties that might not be easily available. So it's going to need. So most times they have these bottlenecks of collateral, documentation issues. That's why there's a need to review some of these things. And I like the fact that these days we have the fintech, companies that they can easily approach and they can get these loans from. So it's important. Access to finance is important. And collateral documentation issues. In fact, another one is even the issue of bank charges. Are there bank interest charges? Because if the turnover, the income is almost like 5 million for the micro in a year, and every kobo would count. Every penny would count. Every pence would count. Every dollar would count. Every pound. You also consider this question to ask yourself, what's the prevailing interest rate? Because if the interest rate is very high, it means that it's going to add to their cost of production. And the question is, will they be competitive with foreign firms? So if the interest rate is about 2 digits, and they also have firms in another country, and money the interest rate in a country like Nigeria is about 28% to get their loan access to finance, and somebody is in another country, still within Africa, maybe Ghana, and the interest rate is about 13%, it means that the company, the firm in Ghana, stands has a competitive advantage over the one in Nigeria. So interest rate is another factor that we want to consider. So we talk about accessibility to finance, you need to also know at what cost. What is the cost of funds? Another question we want to also look at, we want to consider that also pop up under accessibility to finance is what is the duration of the loan? And this is duration of the loan is very critical, very sensitive, and very important, especially for agro-allied industries, because there's usually a time lag between the planting and the harvest season. So if you have approached a bank for a loan and it's about 12 months and you're going to plant and wait for 8 months, it means such a company can afford to pay their loans, monthly. They can't do monthly repayment. So it has to be structured. So you have to be flexible around this thing. So accessibility to finance is not just about the funds. You're going to consider the cost of funds. Is we really make them competitive with their competitors based in other countries. You are looking at collateral issues, look at documentation issues, you look at the cost. Real cost, the total cost of funds, okay, and also the duration of the fund. Is it flexible does it match repayment, match the income period to these questions that has to be asked, factored in when you talk about availability, accessibility of finance, to companies. The question you may want to ask is, are there countries around the globe getting it right in terms of easy access to finance for firms, organizations, companies in their nations, in their countries? The answer is yes. There was a particular report by World Bank on countries with easiest financing access, and it included credit sources and loan requirements. Well, the research was actually based, on surveys carried out on more than 161,000 firms, and what they measured was look at availability of loan in more than 144 countries, and the result, that was gotten was interesting. I want to consider the top 5 countries, according to the report, that offered easiest access to business expansion loans. So these are the 5 countries I'll be calling and talking about right now in the next couple of minutes, are countries that, when it comes to access to loans, loan requirements, credit sources, very easy. They've made it so easy for firms in the countries. The top on the list, is Chile. Okay, it has, in terms of easiest access to business expansion loan, it came out as the top. The first country, in that regard. When it comes to business expansion loans, they came out first, and it was discovered that about 79.6% of companies in Chile either have business loans or lines of credit open for them. 79.6, that's high. Next to it was Peru, which had 77.8% of firms, either having business loans to or lines of credit. The third is an interesting one, and that is Spain. Why I find Spain quite interesting was that it was badly, if you recall, during the pandemic, the COVID-19 pandemic, Spain was badly affected, and in early part of 2020, it witnessed, drastic fall in its loan application. It was at its lowest. But interestingly, it picked up later in the year. So at the end of the day, that in terms of easy access to business loan or lines of credit, we have Spain at top 3. At number 3, with about 76.5% of their firms either having a business loan or line of credit, despite, the effect of the COVID-19 pandemic on Spain. We also have Cyprus, okay, and this can be said to be one of the emerging, powers in Europe, and we also have about 69.4 firms. Also, we have those firms either enjoying business expansion loan or lines of credit, and we have Belgium as number 5 with 68.8% of firms, in Belgium enjoying one sort of business expansion loan. There's another report I saw, and that is quite a bit of time, about 4 years ago, 2019, Best Country Report, and it looked at countries that provided the easiest access to capital. And these countries I'm going to mention now stood out very strong, because these are countries that granted people with great ideas opportunity for financing the ideas. You have any great idea, these countries will back it up. Once they can determine that this is great, it's going to add value to the nation, it's going to benefit them as a nation. These are nations that would fund great ideas. And all of these countries, we call them the Scandinavian countries. Okay, and the Germany stood out strong. We also saw Switzerland, we saw Luxembourg, and also another country we saw is no other than the United States of America, the US. It came out strong in the report as countries that always grant people, that have great ideas, opportunity to finance the ideas. The essence of doing this statistics, comparing this thing, is to let you know that when we talk about economic development, there are a lot of factors, there are a lot of determinants, and one of it is accessibility to finance. Because remember, you have to invest, you need to produce in terms of goods and services for your GDP, for you to take it out there. When your GDP increases, then you can talk about development. So like we always say that liquidity is the lifeblood of stock market. Definitely finance is the lifeblood of any business. It's very important. The next determinant that we'll be looking at is the level of foreign direct investment. This looks at the ability of a country to attract foreign investors into their economies, and this includes the likes of the multinational firms coming into the country to establish their factories, their administrative offices, production units in your country. So, and this speaks a lot to your ease of doing business. This speaks a lot to the level of trust, the state of security of your country. So the more you are able to attract the multinational firms, the way they are able to attract people to invest, it means that they'll be coming in with their funds. And not just the financial, in terms of capital that these multinationals will bring into your country, they'll also be bringing in technical expertise that your people can learn from. So these are factors, these are determinants, of economic development in a country. So imagine if you have multinationals in your country living, to other countries, it means that the income that should be earned, for even as a government, when they come in, of course they'll pay one form of tax or the other. The company income tax to be there, the withholding tax to be there, that very kind of tax, and that is an income revenue for the government. Okay, even if we don't look at the avenue of income generation for the government directly, what about the kind of opportunities that will be provided for your city in terms of job opportunities? What about the corporate social responsibilities, where some of these companies will roll out scholarship opportunities, they would undertake infrastructural development of area where their companies are sited, where their factories are sited. The level, they're coming with a lot of things. So the level of foreign direct investment also speaks to the level of development of that country. Because if they find any place to be unsafe, people don't want to come there. If they find, if they find a lot of bottlenecks, in the logistics, infrastructure, they're not likely to stay. Power supply issues, insecurity issues, all of these bottlenecks, multiple taxation, they will not want to stay. So thus, the level of foreign direct investment is a great determinant of economic development in a particular country. Let's consider another one, which is the state of macroeconomic stability. This is a core determinant in the level of development of a country, because a volatile macroeconomic environment would hinder growth. Now, let's look at important macroeconomic variables that are very sensitive and crucial to attainment of growth. One, what is the level of inflation? If inflationary rate in a country is high, it's going to hinder people, from investing. Okay, because once inflationary pressure is high, don't forget, it means that the same amount of money you've been using to purchase maybe 10 items, once inflationary pressure increases from like a 20% to a 30%, it means that you can only purchase fewer goods. So you are speaking about the real value. Okay, the real value of your currency is going to erode your purchasing power, and once it erodes purchasing power, it means that my standard of living as an individual in that country will decline. And remember, we talked about economic development speaking to the standard of living of the people. So if my income decreases, okay, even if it does not decrease, inflationary pressure will reduce my purchasing power. That's the amount of things I can purchase with my present level of income. So inflationary rate, will determine. So if it's high, definitely the standard of living drops. It doesn't even affect just individuals, also firms, because if inflation pressure is high, it's going to speak to their cost of production. So when inflation rate is high, it means everything they've been purchasing maybe for a few dollars, maybe $20, $50 would increase. It's likely to increase. It's going to increase their cost of production. And when that cost of production increases, definitely it's going to increase, the cost, the per unit cost of their good, or even the per unit cost of their services, and with that make them competitive. So inflation pressure also affects the government. Okay, if it's going to reduce development programs that would ordinarily have been rolled out by government, officials or governmental offices. And what do I mean? If a particular project is supposed to cost the central government, the federal government about maybe $2 million or $200 million, and inflationary pressure comes in, sets in, about 30%. It means that they have to cut down on proposed developmental programs. So it affects everyone. So you want to keep an environment where prices are stable, when you want to bring down your inflationary pressure to a moderate level, because there's another school of thought that says that when inflationary pressure is very low, okay, you are going to discourage foreign direct investment. But you find a balance. That's why we talk about trade-offs. You want to achieve low level of inflation, you may have to trade away low level of unemployment rate. Okay, so you trade off this for the other. But every government will seek to achieve moderate, level of inflationary pressure in the economy, because you don't want to, reduce the standard of it. And recall, we're talking about economic development. Another one that is important, exchange rate stability. You don't want your currency fluctuating. You don't want your currency, the value of your currency being devalued against other currency. So you want to maintain that stable exchange rate stability. Also interest rate, lending rate, also important, because when your interest rate is high, most people are discouraged to produce. They're going to reduce the level of production, investment activities in the country. And again, you want to consider your tax rates. Okay, multiplicity of tax. You don't want to overburden the taxpayers, because when they're overburdened, they'll look for the nearest country where the multinational where they can go to. So the tax rates, must be sensitive to the people, must be reasonable, must be simple, must be convenient. That's why we talk about the canon of taxation, the principles of taxation. So, you want to keep a state of macroeconomic stability, and these are the factors that will aggregate together to determine the level of macroeconomic stability in a particular country. If you can get this right, then you are talking about developmental process, really achievable level of development in the country. So far, We have been able to discuss core economic factors affecting economic development of a country. Now, let's look at non-economic determinants of economic development. The first non-economic factor that I want to look at is infrastructural facilities. Now, the availability and development of infrastructural facilities would enhance a country's position in the development space. When I talk about infrastructure here, I'm talking about communication infrastructure, transportation infrastructure, cutting across the various modes or forms of transportation, your road network, you're looking at your rail, air, pipeline, sea, and so on. Also, you're even looking at power supply. When you talk about, most times you have the companies, the factories situated not even in the urban areas. You have them in the rural areas. So when they're in the rural areas, how easy is it for them to transport their goods from where they have been produced to the cities, to the urban centers? So these are things that will determine the level of development. Also, communication. How can they communicate? Communication that the rural areas, the urban areas, are they well developed? What about power supply? These are simple, as they are. They are crucial in determining the level of development of a nation. Because we talk about economic factors when we talk about foreign direct investment, bringing, foreign capital, bringing multinationals to your country. When they're coming with their capital, their technical know-how. However, what will make them stay will be dependent, among other factors, on the availability and development of your infrastructure. Let's talk about the second non-economic factor, that is the level of education. That is, these are proven that the more educated the people are in a nation, the higher the level of productivity and thus economic growth and eventually economic development. So we are looking at the basic level of literacy and numeracy, of your people, and statistics have shown that this has helped a lot of economies to grow from being purely traditional in terms of manual labor to higher tech industries, especially in the area of the service sector. When your people are educated, when you have workforce that are enlightened, it's going to increase their level of productivity because they will be more competent, they can do more, it speaks to their level of efficiency more with the little resources that they have. So that's why countries, have taken this very seriously. And if you look around, we have countries with very high level of literacy rates. We have Andorra with almost 100%. We have Luxembourg with literacy rate is also close to 100, like 97 thereabouts. We have Norway. We have Finland. And then if you look at the level of development in this country, research has proven, that it has got to do with level of education. It comes to the level of enlightenment, it comes to the level of competencies, which is very key. So the more educated your people are, it speaks to the level of productivity and it helps you as a nation to grow. And let's look at countries with lowest literacy rates and mentioned in I think the first or second episode on this program series. Now we had Chad around 27, between 27 and 30% literacy rate. We have Mali 31%. We have Ethiopia 39% literacy rate, and also Nigeria at 51%. So if you look at this vis-a-vis, you can see that the developed nations have almost 100% literacy rate, while the developing nations, are ranging between 27, 51, on the average 39%. So you see that this speaks to the level of development. That's why no one that they are developing. So level, if it's not important, we should have, if you have 10 in developing and we have 68, 70, then there's a problem with it. But you can see how critical it is. When you have any country ranging between 50-something and less, it speaks to the level of development. That is why you call them developing nations. We're talking about highly developed nations. Literacy rate, level of education has a major role to play. That's it for today. Thank you for staying tuned to the end of today's episode. We hope that we have you here at same time, 5 p.m. WAT next Friday, still on Amagad Radio Communication. And kindly join us on our other programs, which runs Monday through Friday, same time, 5 p.m. WAT. If you have any questions, feedback, you can send a mail to us as contact@theamorgate.org. For feedback, comments, kindly send a mail to contact@theamorgate.org. And want to know more about us, kindly check up on our social media handles: Facebook Amorgate, Instagram Amorgate, LinkedIn Amorgate. Well, good to have you here. We hope that you stay tuned next week. And remain Titilola Ogunshoina saying bye from here.